Traders put their own interests ahead of their customers. They manipulated the market, or attempted to manipulate the market, and abused the trust, I think, of the public, and certainly us as regulators.
I'm absolutely determined that we clean up the corruption by a few in the city so that financial markets work for everyone, and we do have a banking system that supports our economy. It's all part of putting right what went so badly wrong.
5 banks have been fined $3.4 billion. The allegation: widespread manipulation of foreign exchange rates. UBS, Royal Bank of Scotland, Citi, HSBC and JP Morgan Chase all settled with the UK's Financial Conduct Authority and the Commodity Futures Trading Commission of the US in a global probe into rate rigging in the largest financial market in the world.
5 banks have been fined $3.4 billion, but it's in dollars, but it's not going to end at that. It's only basically the first chapter in what will be a long-running investigation. There are around 20 authorities looking into allegations of market rigging by around 15 banks in this market. And there could be, we'll see in the next year or two, we're going to see a barrage of further settlements, similar to the ones we had with the 5 banks now, but also antitrust fines and also potential civil litigation.
But questions have been raised about the speed at which the probe was conducted and its outcome, with some critics concerned the FCA failed to interview some of the main individuals involved.
The FCA asked the main banks involved to do their own investigation and report back to the FCA with their findings. So it was the banks themselves that were interviewing their own traders, former traders, etc. Lawyers say that potentially that gives rise to unfairness because it's the investigated doing the investigation. You also have a particular situation with the FCA. They have a power called compulsion to do interviews. So in those particular interviews, an individual doesn't have a right to silence. They have to answer the question. Now, the complication arises because the FCA and the American authorities are working quite closely on this investigation. And for the Americans, they cannot use this material under compulsion legally. So what you have is essentially a Mexican standoff, if you like, between the key protagonists in this probe refusing to do an interview with the FCA.
As for the banks themselves, there's a clear benefit to announcing a simultaneous settlement. Unlike during the LIBOR probe when Barclays went first, no one suffers first mover disadvantage.
Really, the bank's fine in LIBOR, £290 million, when set against other banks, UBS for instance, it was well over £1 billion. You can see that Barclays really wasn't that culpable, and yet the fallout was so great that banks on FX really feared the same situation. So if they all moved as a pack, no one bank was going to suffer too dramatically. I mean, the great irony, of course, is that today Barclays is not part of the settlement. They chose not to be part of the deal today, and their share price has actually taken a bit of a knocking.
A large part of the Financial Conduct Authority's investigation was drawn from the laddish banter exposed in the chat rooms traders used when sharing information about currency orders in their attempts to manipulate the Forex fix.
It's quite incredible that after all the chat room transcripts and everything that came up in the LIBOR scandal, where we had seen similar fines and similar findings, it's really incredible that the traders still did what they did in the chat rooms and still used this kind of language. Now, what has changed since, I would say, in the past year or so, is that banks have really started to crack down on this.
A separate probe into Barclays is continuing. It had been expected to settle too, but pulled out at the last minute. Meanwhile, FCA boss Martin Wheatley says this isn't the end of the story. Several senior traders have already been put on leave, and the Serious Fraud Office is investigating those alleged to have masterminded the scheme. Daniel Garahan, Financial Times, London.